four, three, two, one. Good afternoon, Quasar Markets Live. I'm your host, Hondo Greenberg. I am so happy to be joined here today by the president of the Blue Collar Investing Corporation, Dr. Alan Ellman. Dr. Allen, how are you doing today?
Doing great. Glad to be with you, Howard.
Let me just fix that sound issue here. I know what that is. There we go. So today I'm excited because I've already picked your brain, as you know, before we even got into the into the room here with some questions, because you sent me this PowerPoint that's fantastic, and I thought we'd go a little bit over. And this is just one of the strategies that you use, I believe, in your company. And if you could tell me a little bit how, number one, how did you get your started in investing, and then after investing in the blue collar investor?
Well, actually, my story is probably a little bit different than most others because this is my second career. Originally, I was a dentist. That's where the doctor comes from. And in the mid 1990s, I realized, even though my practice was going quite well, I realized at some point in time that I would have to have a passive form of income. So I decided, I knew that it wasn't in my DNA to just hand my money over to somebody to invest for me. Although, if you find the right person, there's nothing wrong with that. But I knew that that wasn't for me. So I decided to teach myself how to invest actually in real estate and in the stock market. And I started buying and selling shares of stock based on certain principles. I kind of have a knack for math. So I started creating various algorithms, fundamental technical screening, and so on and so forth. And I was doing quite well. Then one day I was reading an article, actually, it was in a dental journal, about a dentist that was investing with options in the IRA account. And I said, wow, I always thought options were kind of risky. How's that possible? And it went on to talk about covered call writing. And intuitively, it kind of attracted me. So I started teaching myself covered calls. And then I was still in dental practice doing root canals and crowns. But in 2007, I decided to write a book on how I was investing. It's called Cashing In on Covered Calls. And boom, it went to number one on Amazon on options. Then I started getting invited to speak all over the country. And I had to make a career choice. So in 2013, I hung up my dental drill. And here I am now with the blue collar investor and loving every minute of it, Howard.
That's great. And it's so interesting on a story. Myself, I came from a very different background also, and, got into investing later in life myself. So I love when others do that. I do want to tell people, too, one thing that really impressed me as I looked through all of the information that you have and have been talking to you is you really have a teach people how to fish approach to what you're doing. It's not just a cookie cutter that a lot of different people have, where it's, hey, I'm just going to give you a stock a day to pick, or I'm going to show you, I'm going to give you a broken wing butterfly, and you're going to put it on, and you might not know why you're doing it. You're just going to follow. And so what I was really impressed as we've been talking is a little bit about your company. So if you could give me a little bit more about the blue collar investor.
Well, basically, we're an educational and stock screening service. So over the last 30 years, and that's about how long I've been doing covered calls now. And again, I'm self-taught. I would start making trades, and when the trade didn't work out, I would ask myself, how could I have avoided those losses or mitigated them, maybe turn losses into gains? And if I made money on a trade, I would ask myself, is there any way I could have made even more money?
Right.
And I would start creating various rules and guidelines and formulas. We've developed over 12 different spreadsheet calculators. In addition to the books, I've published 9 books, written over 700 articles, and produced over 500 videos on covered calls and cash secured puts. So what we do is I take the information that I learned the hard way, and we share that with the BCI community. How to enter a trade, what stock are we going to select, what option are we going to select, and once we do that, we're not done. How are we going to manage the trade? Because frequently, exit strategy opportunities will come up that will allow us to mitigate losses and enhance gains. So all that is taught at the BCI. And we also have a very rigorous screening process, which I'm 100% transparent. So if people want to do it without becoming a member, they can actually do it, Howard. And
Oh,
that also probably sets us
that
apart from a lot of
definitely
others.
sets you apart.
But this is a hobby for me.
Yeah.
I just love doing this. And but I will say this: the screening that we do saves our members just huge amounts of time. So when these watch lists are published on our website, all they have to do is print it out, and boom, there it is in front of them, and then they could choose from that. So instead of having 8,000 securities to deal with, now they have maybe 30 to 40. So it makes life much easier
Yeah.
and makes the process much simpler.
But it's still a robust list, so people get their own investing style and their own goals. Every investor, as you talked about as before we came on, has different goals, has different risk, that they are willing to take, and have different time frames. People, again, I always go back to my side on crypto, and when people talk about Bitcoin and how risky it is, I ask what their time frame is,
Yeah,
because
there is. Yeah,
it changes everything.
yeah. There in our reports, we have stocks, $20 a share, and we have stocks $800 a share, and that's not because I selected them based on price, but because those performers at that point in time. And we have members that can do stocks for hundreds of dollars a share. And we have other members that need the $20 because of the amount of cash available. We also provide implied volatility stats in our reports. So for some investors, their personal risk tolerance is at a higher level, and they can go for the higher implied volatility securities, which generate more premium, but also create more risk to the downside. So,
Right.
which is the right one? I can't tell them, but here's the list of elite performers. Here's all the data, and they could select from that list.
It's great. Well, why don't we get right into it? I know today we're going to go over covered calls. I do have up on the screen the PowerPoint, so I'll go right into the first section here and let you get.
Okay. So, Howard, this is a PowerPoint slide that I created maybe 3 weeks ago. And I've been using it in all my presentations since then because I like to give investors a framework as to where they are in terms of their risk tolerance and
Right.
what they can anticipate in terms of the returns. Because as you know, online and wherever they're actually getting information and education from, a lot of times they're promised very, very high returns in a very short period of time. And that's okay if your personal risk tolerance falls into that category. But for many retail investors, that may not be okay.
Right.
We all work very hard for our earnings, and we may want to generate higher returns than risk free, but we may not want to risk that money in a very extreme manner. So here's this slide that I created recently. To the left of the slide, and this is a risk reward spectrum.
Yep.
So to the left in the bottom is low or no risk, things like treasuries, money markets, CDs. So something happens with the US government, we would consider these no risk investments, but low returns. Still significant, but low returns. To the right of that, that's where we are for those of us investing with covered calls, and the same holds true for cash secured puts. We're a little bit to the right of no risk, but we're not all the way to the extreme high risk part of the spectrum. Now you'll notice, Howard, that to the right of that, I put down buying and selling stock. So why do I have covered call writing as safer than buying and selling stock? And that has to do with our break-even price points. Let me give you a quick example before we move on. Let's say we buy a stock at $48 a share. What's our break even? 48. Price goes up, we make money. Price goes down, we lose money. But let's say we bought the stock at 48 and we sold the $50 covered call and we got $1.50 in premium, 150 for the one contract. Well, now what is our break even price point? It's 46.50,
650.
right? So our break even price point is lower, and therefore our portfolio volatility will be lower and our risk will be lower. Now,
Sure.
sure, we're capping the upside. That's the disadvantage of covered call writing. We're capping the upside, but still our risk is lower. Now, to the right of that, I put down things like naked options or shorting stock or even casinos.
Yep.
Casinos are defined, in my definition anyway. Here's Alan Ellman's definition of a casino. You give them $1 and they give you back 85 cents.
That's right.
Well, I don't like those odds. So that, yes, you could make a lot of money quicker, but is this your personal risk profile? It may be, it may not be. All the way to the right of the spectrum are lottery tickets. And of course, if you win the lottery, it could be life changing, generational money, but 99.99, probably more than that, at the time, you're throwing your money down the incinerator. So
Absolutely.
there you have it. Speaking to everybody listening to this presentation, where do you fall? I don't know. You should be able to figure that out. But with covered calls, you're all the way to the left of the profile.
Yeah, and I don't think people do understand that you do mitigate your risk. You're bringing down, your money risk, and you're already getting cash right off of the bat when back with your process. So we'll get more into that. And those casinos, the meme stocks could go right into that area also, and your meme coins in the crypto phase go all the way to the lottery tickets.
Right.
So on our next slide, you give the analogy with your real estate.
Yes, a lot of people that never had heard of covered call writing or maybe heard of it and have no clue what it's about. So a lot of times in my presentations, I'll give like a real estate analogy uh, because in essence, it's almost like we're renting out the stocks when we
Yep.
write a covered call. And then as we go through the PowerPoint, Howard, we'll give a hypothetical and then a real life example.
Yep.
So let's say we buy an investment property, we buy a home, we buy a stock. Okay. Now we are covered or protected. We know our cost basis. Now what we do is we rent out that home to some unknown person. It might be that guy over there. And that guy over there pays us a premium, a rental income. But he also has the right at the end of that contract period to purchase the home at a price that we, the option seller, the investor who bought the home, puts down in the contract by a certain date. So, for example, we may have purchased the investment property for 100,000, and for $10,000, we're going to allow him to control that property, to rent it out, and at the end of the contract, he'll have the right to buy the home for, let's say, 150,000. That's how it works.
Yep.
So we are contractually obligated when we sell this option or sell this right to control the home, to sell it at the price that we determine, 150,000, by a date that we determine. Let's say it's 6 months out for the investment property.
Right.
Now, at the end of that 6 months, yes, the renter has used the home, has controlled the stock, right? And if the value of the home is still 100,000, well, they're not going to buy it. But if the value of the home pops to 175, they're going to buy it at 150 and have an unrealized profit right off the bat of $25,000. So that gives you a framework as compared to real estate. And now we can move on to a hypothetical with stocks.
You got it. And like you said, I think a big part that some people don't understand is you're predetermining what the price is that you're willing to sell the stock at. So it's not the buyer's deciding they want to take that contract on, but you as a seller also have to decide what that price is, and you're pre-doing that. So
Yeah, that's a good point, Howard, because we as the option sellers actually set the parameters of the contract.
yeah.
And because we buy the stock first, we know our cost basis. We're covered. That's as opposed to naked options trading.
Yep.
So we are covered. So here's a preview example, Howard, where we buy 100 shares of stock at 48. Now, I say 100 because for every one options contract we sell, in order to be covered or protected, we must first own 100 shares of that underlying security.
Right.
So we buy 100 shares. Now we're covered or protected. Now we're free to sell the option. In this hypothetical, I just put down a nice even number, $50. So we buy at 48 and we agree to sell our shares at 50, and we're going to make this a 1 month expiration. So anytime over the next 1 month, the option buyer can exercise and buy our shares for 50. Now, let me just say, if early exercise almost never happens, So if it's going to be exercised, it'll almost always be after expiration, after the contract expires. And I'm going to show you when that would happen.
Okay.
But if we're paid a premium of $1.50 or 150 for the one contract, our initial profit, and that's about an average premium, Howard.
Right.
So if the underlying security was less volatile, you get a lower premium. And if it was more volatile, you get a higher premium. We'll go with 150. So our initial return is 3.1%. And just to give you a framework, all right, that annualizes out to 37%.
Right.
Now, that doesn't mean that's where you're going to end up. You could end up higher or
Yeah.
lower,
Yep.
but that's our starting point. Okay.
Right. That's a good starting point. And like you said, you know all of the components going in. It isn't, you own the home already, so to speak, in the way of the shares. You're going to determine at the time frame that you want to, basically have this expire. And like you said, usually you don't see anyone exercise until that time. And then you're also deciding what premium you're willing to take for it, what price you're willing to take for it.
Yeah. What? By the way, Howard, if this trade, if I entered this trade and it was exercised early, I could care less if
Yeah.
my shares are sold early. The reason for that is that that means I have my cash back. I've
Quicker.
maximized the
Yeah,
trade,
that's better.
maximize my trade. I have the cash back, and now I could use that cash to institute a second income stream in the same contract cycle.
Right.
So, have my shares, enjoy everybody. But if you're writing covered calls against stocks that you own and want to keep, there's a certain way of doing that. A little bit.
Absolutely, absolutely. So before we go further and we get into an actual, example, I think people get to their minds around it once we start to bring in a real name or a real function. Do you have a sweet spot that you look for price wise when you're looking at stocks?
Well, Howard, I avoid penny stocks, number one. And then what I do is we have a very rigorous screening process. It's a three-pronged screening process, fundamental analysis. I do a lot of the Investor Business Daily screens, and we
Okay.
have our own database of securities that we've identified over the last 17 years that are potential option selling candidates. And then we put in certain institutional components. I don't really need to go into detail on
Sure.
these, but it's about 12 different screens. So when a security passes those screens, and they're not a penny stock and they have a certain amount of minimum trading volume, et cetera, then I don't really care what the price is. It
Oh,
makes our list.
sure.
And then our members can determine whether or not that cost per share fits what with the cash available they have in their portfolios.
And that's great because it's not tailored to one person or one size portfolio. You're going to handle everybody from the small investor to the largest investors that run the gamut of what they might be looking to spend on a stock in this type of situation.
Yep.
Okay, so preview scenario number one.
Well, there are two possible major outcomes based on that slide you just moved from.
Yep.
At the end of the month, at the end of the contract month, if the price of XYZ, which we bought at 48, is still under that $50 agreed upon sales price, the share prices will be purchased. Why would the option buyer buy our shares for 50 when they're trading at market at a lower price? Just not happening. So the option expires worthless. Now we keep the $150 no matter what. That's ours
Yeah.
to keep no matter what. But we also now retain our shares, right? So we're free to sell another option in the upcoming contract cycle. So that's one. Now the second possible major outcome is that the price of the stock does in fact supersede the agreed upon $50 sales price. Now, just as an aside, if we don't want our shares sold, Howard, we can always buy back that option
Right.
prior to contract expiration, 4 p.m. Eastern time on expiration Friday. But let's assume we don't. And the price of the stock goes over 50, we leave it alone. The stocks are sold after expiration on Saturday. Log into your brokerage account. You'll say, hey, where did my shares go?
Hmm.
And then you'll go, hey, where did all this money come from?
From.
I
Yeah.
sold at 50. So where do we stand? We made 150 on the sale of the option, another $200 on the sale of the stock for a total of $350 on a cost basis of $4,800. That's better than a 7% 1 month return. Howard, I must
Right.
say this. Right now, everything looks just terrific with this. This is not a no risk strategy. It's a
Sure.
low risk strategy. So if XYZ drops below that break even price point of 46.50, we start losing money. And
Right.
that's where your exit strategy skill set must kick in.
Yeah, absolutely. Is a great point there. But it is funny. I have some people that are part of the Quasar market, contributors, some guys from Bullish Bears, Jeremy Vreeland, who they use this philosophy. They call it do more of what's a wheel trade, but their goal is to own the stock outright for free by being just enough outside the money that it's worth their while on a monthly expiration to sell their the covered calls, and then they're hoping it doesn't get picked up and then rinse and repeat to get the stock basically free at the end of a term. So I've seen this played, a similar thing with this played a different way.
Well, I call it the PCP, or put call put strategy, but it's mostly known as the wheel strategy,
Yeah.
and that's a multi-tiered option selling strategy. It's a very nice strategy. You have to master both covered calls and cash secured puts, which is great. And then you have to determine what your goal is. Do you want to own the shares quicker? Do you want to avoid exercise? And there's
Right.
actually ways of quantifying the
Oh
risk of
yeah. Yeah, it's very complicated. I've never done a wheel trade personally. Done covered calls
Well, you're
and
a smart guy, Howard. You can pick this up very quickly. I promise you that.
I've done some of this, not with as much. Quite honestly, is not with as much due diligence as obviously comes with what you
Well, I've
guys
been doing
do.
this for 30.
Yeah,
I've been doing this for 30 years, Howard. I don't think anything can happen to me that's not already happened. So,
I'm sure. I'm sure.
yeah.
So now we're
All right.
looking at the option chain here.
Okay. This is an option chain that I created this screenshot recently for one of my presentations. Chipotle Mexican Grill. It was trading at $50.58 on 8/13, and it's for the 9/20 contract expiration. So it's about 5 weeks out. Now, what I did was I highlighted three different types of options that we could sell. And I might be getting a little bit too much into the weeds, but I know that you're a smart guy, and I'm sure a lot of your members are pretty smart. So I'll do this basic calculations for you with the three different types of options.
Sure.
The one where you see the 48 and the brown cells at the top, that strike price is lower than the current market value of 50.58. So in essence, we're agreeing to sell our shares at a lower price than we're currently trading for. So why the heck would we do that? As you'll see, it will give us additional protection to the downside, something we may be interested in volatile or bear markets, or maybe certain events like before an election or
Sure.
before a Fed announcement, et cetera, et cetera. So the in the money strike lower than current market value, very few covered call writers use this. But if you learn how to use it, and I promise your members this, it will put cash in your pockets if you know how and when to use it. The next strike I have highlighted in the yellow cell is the 51 strike, which is very close to the price of the stock at 50.58. That's called near the money, a near the money strike. And then finally, the 54, which is much higher than the current market value. That's called out of the money in the green cells. So you see the bid prices of 420, 250, and $1.30.
Yep.
Now, Howard, my team and I created a spreadsheet called the Trade Management Calculator. It has over 2,400 formulas inherent in the spreadsheet, and it allows you to enter your trade, get your initial calculations. There's over 20 different exit strategies inherent in the spreadsheet. It
Wow.
gets your per trade post adjusted calculations and your total portfolio. What you're looking at here on this screenshot is just a small little snippet that I piggybacked two small sections. So on the top are the trade entries. You could see in the middle there, the stock was trading at 50.58, entry stock price in the blue cells. And then you see to the right of that, the various strike prices, the in the money 48, the near the money 51, and the out of the money 54, with the premiums I just alluded to. Now, at the bottom section here, you'll notice your break even price points in the yellow cells. So if you take a look at the break even price points, you'll notice that 46.38 for the in the money strike is the lowest break even price point. So I think you will see that in a bear and volatile market, or if there's an event coming up, or maybe you just sleep better at night having
Yeah.
this insurance policy, then you could still generate in the green cell there a 3.38%. That's time value only. Not, it doesn't include the loss that you're going to have on the stock side from 50.58 to 48. That's
Right.
time value, that's real profit, nothing exaggerated, and based on a 39-day lower left, which the calculator calculates for us, 39-day trade, annualizes out to over 31%. Now, take a look all the way to the right in the green cell,
Yep.
downside protection. That's 5.1%. What that means, Howard, is the following. We are guaranteed a 3.38% 39-day return as long as share value does not decline by more than 5.1%.
Right.
That should explain graphically when you would use the in the money strike.
Yep.
Now, the at the money or near the money strike always gives the highest initial return. In this case, in the brown cells, 4.94%, 46% annualized. But you'll get very little upside opportunity and no downside protection of that time value profit.
Yep.
And finally, the one that we're going to use the most, the out of the money strike, like I did in the preview, 48 to 50. Here it's 50.58 to 54. That's a 2.57%, 24% annualized in the pink cells. But look, we have an opportunity for an additional 6.76% if the price of Chipotle goes from current market value up to or beyond that out of the money 54 strike. So in essence, you can get about a 9% 39-day return
Turn.
using
Yeah.
that particular strike. So each one has its advantages and disadvantages.
And that's great. So even when you get through that first criteria that you talked about, where your clients get to choose which of the stocks to look at and use, you're also giving them choices of once you're in a trade. Here is some risk reward, or as you're setting up your option part of the trade, here the risk reward on that stock based on different things. So there's even different
Yes, in other
levels
words,
of risk as you get along.
yes, you can make your selection of the underlying security and the option based on your risk reward profile
Yeah.
and your personal risk tolerance. Now, for me, when I set up a monthly trade, and I'm very structured, so I almost never veer from this. What my initial time value return goal range is 2 to 4% a month. Divide that by four when I use weeklies. Now,
Yep.
the only time I'll go higher and I'll go up to 6% a month, but never, ever, ever higher than that is in a raging bull market, which is kind of rare. But
Right.
when we have a raging bull market, I'll go as high as 6% because, it's in my favor. The market is going up so much. But typically 2 to 4%, and that applies to the actual real time value profit, whether I use an out of the money or an in the money
Money.
strike.
Yep. Yeah, I mean that's it's right there in front of you, and like you said, you've put it into a way that it is easy to visualize and understand. The difference between the three strikes. So it's you're not going in and out of screens and out of screens. You're able to say, okay, let me put it down the three different ways I'm thinking about playing this option, and then I can see my risk reward, and all three of them laid out right in front of me.
Also, Howard, there's no law that says if we're selling 5 contracts of covered calls on a particular security, there's no law that says we have to sell five out of the money,
All the
five in
same.
the money. If we're slightly bullish, we might go 3-2 or 4-1,
Right.
and
Like
kind of
I was going to ask you that question. Do you ever use this to hedge? If you did get three, four, five of them to hedge a little bit downside protection in there.
Yeah, I do. As a matter of
Yeah.
fact, in our weekly reports, when contracts are expiring, I actually let our members know I'm leaning bullish and I'm favoring out of the, or just an example,
Yeah.
and I'm favoring out of the money to in the money call strikes 2 to 1, something like that.
Yeah.
Now that doesn't mean they have to follow what I do, but that is telling them that based on my personal risk tolerance and my overall market assessment, which we look at very carefully,
Sure.
that this is what I'm doing for the upcoming contract cycle. And they could do it or not do it. I mean, one size does not fit all, Howard.
No, not at all. So I have to ask you next. I haven't seen you talk too much about the Greeks, and I love that because, again, as someone who understands them just enough to get myself in trouble,
I don't believe that. I was
my
trying.
next question would be, um, I'm one of those weird people. I can do all the calculations off the top of my head. I can tell you theta and what it means on a daily basis, and that. But then I don't do a great job of correlating or then using it for stock selection. And I think that's why I would be scared sometimes. But it doesn't seem like I have to have that innate knowledge to do this, strategy. Is that correct?
Well,
It's sort of in the way
yes,
you.
yes and no, Howard. I mean, it's very, very important to understand the Greeks and the factors and the risk involved. So, the main Greeks as it relates to covered calls and cash secured puts are delta, theta, and vega. So, with delta, one of the three definitions of delta is it'll give you the approximate probability of an option expiring in the money or with intrinsic value. Now, if you don't want that option exercised, it's important to understand that something that has a delta of 70, there's 70% approximate probability of expiring in the money and
Right.
subject to exercise. So it's important to understand delta from that perspective. But you also know that if you're selling an in the money strike, that the chances are greater than if you sell an out of the money strike that you'd be subject to exercise. Now, theta, for example, is time value erosion. Now, time value erosion is important in helping us determine when we enter our trade, right? Because when we write covered calls or sell puts, we're capturing premium. And it's kind of like, if I can give an analogy, it's kind of like if you go in and buy a car. So you buy the car and now you pull out of the dealership, the car's worth less right away. As
It
soon as
depreciates.
you pull
Yep.
out, what happens a month later? It's worth less. Same thing with our option, the time value component of our option premiums. It keeps decreasing, but it doesn't decrease linearly. It decreases logarithmically. It's kind of like a slowly, 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 then it falls off a curve. So that tells us if we're selling a monthly or a weekly option, which is what I favor, we want to sell our premium early in the contract, not later on. It
Absolutely.
also tells us that if we're going to institute an exit strategy and buy back that option, we're probably willing to spend a little bit more money early in the contract when theta is going slowly
Still in
rather
your
than later
favor.
on in the
Yep.
contract. And I have specific guidelines as to percentiles to use when buying back that option. So theta is important. And as far as vega or implied volatility, that's important too because it'll determine the risk involved in our trade.
Trade.
So the
Yep.
higher the implied volatility, the greater the premium, and the greater the risk to the downside. So understanding the Greeks are very important. But looking up stats,
Right.
25% implied volatility or whatever the vega or theta or delta stats are, generally speaking, you don't have to do that as long as you understand the concepts. But there are a couple of exceptions.
Sure. You're more looking at generalities than as a specific maybe where you have to know a formula that Vega's got to be above or below this, and if it does these 17 things with your formula, it looks like it's once you start to you first of all, it looks like it's chronological in that you sort of hit them as you're doing things already. You're sort of knocking them down because if it doesn't have the volatility, then you're not going to have the premium to be involved in the trade sort of to start off with.
See
Would be
that
my
you figured this out yourself, Howard. You really don't.
I would not go that far at all. At
Well,
all.
you hit the nail on the head that when you look at your option premium, the implied volatility is inherent in the premium. So if you take a look at a 1 month near the money call strike and it's giving you 10% for that month, the implied volatility is through the roof and you may want to avoid it. That's why I say I shoot for 2 to 4% a month. I don't have to look up IV stats because I know that's within my comfort level.
Right. So that's where it hits. That's what I sort of meant. Is it's not this overwhelmingly hitting you. You're already narrowing it down by setting criteria before you even get to this point. Because I think what happens for me is I see that option chain that we brought up here and the one before, and then I start going crazy here. So that's what I like is not having to get to that screen, and I'm not measuring again 7 or 8 different Greeks versus each other to make a decision. I've sort of narrowed down as I've gone along in my criteria to get to those points on there. One question I have to ask though, do dividends come into play into your strategy? Or does that sort of rule more of them out because they're not as volatile stocks that they don't pop up as much?
No, I have no problem with dividend stocks as long as my criteria. Now, when we do our screening, we don't specifically screen for or against dividends.
Okay.
We look for elite performance from a fundamental perspective, sales and earnings growth mainly, and then we look at a technical chart. So we look at trend and momentum, and of course we compare that to volume. But I tell my members, here are the four parameters that I use and have been using successfully for 30 years now. If you have special indicators you like, I'm good with that, just as long as you're measuring trend and momentum. And you want, when you're looking at a price chart, you want to see those lines moving quickly because these are short-term trades. So I don't like simple moving averages. I like exponential moving averages. And so, yeah, so you use those technically. And you know what, Howard? I forgot your question. What was your question?
It was how dividends come into play.
Dividends. Okay. So once I do my screening and I have a list of the elite performers, now some of them are going to have dividends. And if I happen to capture a dividend during that contract cycle, I consider that icing on the cake. However,
Okay.
I will not pick that stock because it has a dividend, because the amount of dividend income pales in comparison to the option premiums. So you have to focus on what your goal is. Get the elite performing underlying security, select an option that suits your personal risk tolerance and time value initial return goal range. And if it happens to give a dividend, great. One thing about dividends that your viewers may be interested in is that the most common reason for early exercise of our covered call options is an ex-dividend date.
Yeah.
So if that stock does generate a dividend, and if it is super critical to you not to have your shares sold as a result of exercise, then you must avoid the ex-dividend date.
Yeah.
And that's the date that you must own the shares in
To
order to
get it.
capture the dividend. So if you're going to get exercised early because of an ex-dividend date, I'll tell you right now exactly when that's going to be. It's going to
Right.
be the day prior to the ex-dividend date. So sell the option on the X date or after, and then you're
Right.
okay.
Okay. That's
Very rare.
perfect.
Even with the X date, it's still very rare.
Right. I would guess that's the analogy of don't pick up pennies in front of a steamroller. If you worry, don't worry about the dividend part. Like you said, it's icing on the
Yeah.
cake. It isn't the thesis for the trade and the way that you're doing your trading.
Yes.
Alan, thank you so much for joining us today. I'm going to let you go. We've been going here about a half hour. That's a perfect amount. I do want to tell our viewers you're going to join us every Monday at 11 a.m. to go over your strategies, to talk more with us, to get us education. Where can they find more about you? Where can they find you? I do have your website up on there for everybody, which is www.thebluecollarinvestor.com. But are there any other socials or anything you wanted to share with us, or is that the best way to do it?
Your members can email me directly if they'd
Okay.
like at Alan, ALAN, at thebluecollarinvestor.com. We answer all our emails. Also on the website, we have a free beginner's tutorial on covered calls and cash secured puts. Just go to the free training link and then you'll have several choices. I would suggest you start with covered calls. It's a little more intuitive than selling cash secured puts. And the course is 8 videos. They're about 10 to 12 minutes in length each. You can download the slides if you'd like, and it'll give you an overview of covered call writing. If I can give an analogy, it's like the cliff notes we used to use in school. It's an
Oh, that's
overview.
perfect. Well, I'll definitely be doing that here in the next day or two. I also, when I put this online, Alan, I will put a QR code that gets people the ability to go right to that URL that you have. So they'll be able to do that right off the video here on YouTube and on our site. And again, I want to thank you so much for joining us today, and we'll see you again next week. Thank you, Alan.
My pleasure, Howard. Take care.